Hello guys, glad to have you on board again today. Part 2 series of that year-end review, or at least heading into 2023. Part 2 means that if you were looking at this video first without having a look at the part 1, I sincerely suggest you stop that one and look at the first one instead, just because lots of the things that I will talk about in this video will be blurry to you if you don't have the background models that orientate the decision-making process. Remember that models are no more than a way to make rational thinkings less personal and emotive, not necessarily predicting the future. It all comes down to risk management in the end. Basically, the models are just here to orientate the decision-making process to one direction rather than the other. Though in that second part, we'll have a look at how to put those models into a risk management perspective on my own personal portfolio. Whatever I'm saying in here is where I put my money. I'm not an analyst. I don't sell shit. I don't sell newsletters. I don't sell coachings or whatever it is. I just share what I do because I think people can benefit from learning how traders do actually build their strategies and put them into market perspectives. So what I do here is just sharing the way I do things so that I hope you can profit from a portion of it. Don't be dumb enough to copy. That would be the stupidest thing to do. So without further ado, enough introductory statements, let's go right into the market. We're going to start with the S&P 500. Remember all the models that we've talked about in part 1. The macro model says two things, that we are in a stagflation environment and therefore there is a huge competitionary environment to overperform the inflationary environment, which is still going to be persistent over the next few years. There are very limited chances to go into deflationary environment and therefore switching out into more depressive environment. We currently are in stagflation. This is moderate stagflation, which means don't dare copying the models of the 1970s and the like. For now, inflation is not out of control, and the desperate Fed actions last year, despite the fact that it have been a bit too much, have still so far succeeded in breaking the earlier stages of inflation. So next year's challenge will be to maintain that grip on inflation to avoid having a second inflationary cycle that could go way beyond the 6% that we've had on different measures of inflations. Okay, so that's the thing. We first of all, before going into the S&P 500, gonna give a little bit more depth into the other fundamentals that we've discussed, basically looking at the 10-year yield to highlight just one very particular element to show you that graphically there has been, I think, a policy mistake from the Fed ends in November's meeting, and that this, in terms of market forecast to me, will have rippling effects due to the fact that basically, if you look at the curve that we've been so far, this is the top end of the yield bracket. Remember that the Fed sets a bracket of 25 basis points for the Fed funds rate. And basically, you can clearly see that to me, one thing stands out in that big overall curve is that the November level. It also shows that the 10-year yield has basically sent a message to the Fed at that point. Well, 75 basis points, if you do it, we might cross below, which means, well, you rather like to go for 50 basis points, which would be a safest move. But the Fed instead decided, no. We're going to go aggressive. They wanted to keep on that preemptively raising interest rates stupid narrative. Though I think there has been a policy mistake in the November's meeting choice. Should have been 50 basis points instead of 75. That has caused a crossing down of the 10-year yield, which is significant because it crossed below the lower bracket. Remember that the lower bracket was a 3.75 and the 10-year yield clearly has traded and closed below, which is very, very significant. That's a sign that the 10-year yield has sent a message, you've over-tightened, and there's going to be consequences in the future. This is not the same old thing as yield curve reversions that precede recession. It just says in a stagflationary environment, I expected the 10-year yield to oscillate across the Fed funds rate, and that there will probably be crosses below, and that will be the sign that there are probably going to be negative consequences in the real economy of the tightening cycle. So that's one thing to take away. It's visible for the 10-year yield, and that shows that the Fed should have opted for 50 back then, and should still be on a 50 basis point rate hike cycle. And if they have done such a thing, then we would never have seen a cross under type of behavior from the 10-year yield. So there's been an over-tightened message sent by the smart money investors. As I always said, the bond market doesn't lie. Lots of markets can lie, but not this one. So this is really the thing there is. There's still some liquidity in the 10-year yield. The Fed still has room to grow in their tightening cycle, but they've already made one mistake, and I expect others to come. On what we've said on the previous video as well, is that I think next year's mistake of the Fed is likely going to be about the stupid narrative of we're going to plateau, we're going to stay there, and there's not nearly going to be a rate cut until 2024, despite what I think is going to be a hell of a lot of problems ahead of a 6 months time span out of the current preceding mistake. So I think 6 months away from November is what generally the market is anticipating. So call it that way. I think around May, June next year, we're gonna have to see the real world problems that the bond market hasn't anticipated 6 months before. So I think something's gonna break around May or June. Though take that assumption in terms of timing, I think there's going to be some dangerous timings in the sell in May kind of narrative stuff. So pay attention to this one in terms of timing. That's the message that I can take away from the 10-year yield. It would worth pointing out the junk bonds kind of context as well. Remember that there still are some deflationary risks in the economy. 2 of them, actually the first one is technology improvement, which we said. I don't expect these to break through in 2023, but there has been some significant advancement in 2022, AI, and the things we've talked about, fusion advancements and stuff like that. So don't forget about the deflationary forces of innovations, as well as the shitty credit bubble that there is in the corporate bond of the United States. So it's definitely there is a significant problem which is inherently stronger anywhere else but in the US. But the thing is, this is really a US-centric problem of over-debted and leveraged companies who've been rolling their debts and asking for lower yields for years and years, and now that the yields have finally broken their long-term trends, we see that there's a clear problem on the junk bonds pricing. They remain flushed back to supportive territory, kind of couldn't find anywhere of relief. So it might be one big topic for 2023. If this one were to break lower, that will be the sign that something breaks. Bear that one in mind with what we said previously. I think something's going to break in May, or somewhere around May. At least the 10-year yield has sent a message that, in my humble opinion, will be coming to true life within the next 6 months. So consider May as a maximum. I think the market is going to price that in 3 to 6 months ahead, because that's generally what the professionals are trading. So considering it that way, I consider there will be a problem anywhere between March and April, May. And I would like to look at this problem by the junk bonds to know if this problem comes from these zombie companies, which I very well think they will. That's for it. I'm not going to talk about the dollar. It's probably going to be a messy year for dollar, but I don't want to go down this rabbit hole too much. Let's go back to the S&P 500 itself. Very much more interesting. So remember that we're looking at weekly and monthly charts in here because we kind of make forecasts for 2023. Of course, not being dumb enough to say these things have to happen by the 31st of December. I'm not an asshole. I'm a trader. So I can tell I will look at the weekly and monthly charts to try giving a rational behavior of what the market direction should be, at least for the year or couple of years ahead. And definitely don't take it for granted by the 31st of December. That would be stupid. Though the thing is that if I have a look at these longer term context monthly on the S&P 500, well, good luck calling that a bear market. Once again, that doesn't make any sense to me. This market is crazily bullish. The trend channel is, the context channel is rising, and we're still trading on the top 50% of it. So definitely, absolutely outrageously stupid to call that bearish. We've barely retraced 23%, and the market is already oversold. So I'm sorry, folks, it's definitely not bearish. The worst case scenario would be a pullback, and during this cycle, we can see that the definite maturity of this cycle of trend after breaking out of this massive range, and that's also the sign of multi-year secular bear market trends. So the real trend is on a much higher time scale, but the one that we're currently trading is a monthly trend coming out of this big range that we've created out of the 2000 bubble and 2008 market crash. There has been 2 trend follow opportunity when the market pulls back to the lower term moving averages. One has been there, the second one has been there. COVID has been just another piercing line below the previous level. Basically, prices have been traded, but not too long, thanks to the big monetary mistakes of the Fed that has been basically opening the credit facilities to endless amounts of credits. Though, of course, like we stated, diluting the value of the denominator, the dollar, and basically pushing assets prices up, which means despite the fact that after that breakout, we've made the 2 trend following opportunities, the market should be slowing down and create kind of a divergence to pullback system. We actually have kept rising instead of slowing down. We accelerate, and we can clearly see that with the context boxes being unfolded in here, signs that the market is excessive, and we have to explain that, or this is just speculation. So don't call it a speculative bubble. There can be fundamental reasons for prices to go up. And remember one thing, what does the market do? What is it doing? Is the market following the economy? Is the market anticipating the economy? Or is the market just setting a price for buyers and sellers to agree upon? That's really the way it is. It's the second one. So don't make that mistake to call the market a future forecast of the economy, states, or whatever. It might be derived from this. It's not entirely true, but that's, of course, a component of market pricings, but that's not all of it. Don't forget about the denominator. We're just exchanging stuff. The stock market is exchanging stocks against currency. Though, if you debase the currency, the prices of stocks go up. Their relative value hasn't changed. You can still buy the same amount of bread baskets or whatever with the same stocks, but basically the denominated value in dollar has shifted. So that's the thing. In a stagflation environment, stock markets go up. That's the way it is. The worst case scenario, they go flat because of the economy slowdown. But net, the asset prices keep going up, or at least go flat. So I'm sorry, folks, those who say bear market in a stagflation environment makes no sense. There will be inflation, and this inflation debases the denominator. That's something that you have to understand. It's not that complicated, but those market excesses we see here is just because basically $1 of $2 has been printed in the latest couple of years. That's definitely something that debases the currency. So prices had to go up. We might have done it in a very, very unconventional way when you look at the long-term charts, but boy, that's just due to the denominator. If I was dividing that thing by the M2 money supply, you would see the actual pullback, which tells us one thing. The pullback is already in terms of valuations, which means the overall valuations of assets hasn't moved that much through the latest few years. It's just a currency debasement. But when we trade assets, what we care of is their price. And when we try to forecast where the price equilibrium will be, because that's what markets do, they produce prices, well, what the model says is prices will go up. The worst case scenario is that they will stagnate because the economy slowdown will be so dramatic that it actually offsets all the inflation. There are likelihood of this to happen, but like we stated, for now we're not in a violent stagflation environment like it was in the 1970s, because if we were looking at it, this is basically what happened back in the 1970s. No shit, Sherlock, the market was flat, up and down, and both breaking resistances and support actually. So, sorry for the bears, they're wrong. And once again, they keep thinking that the prices will go down. It's not likely going to happen. Even in a violent stagflation environment, it wasn't the case. So we're in moderate stagflation, which means there's still sufficient level of inflation and the economic growth is at least taken by this inflation, which means the net growth is close to zero or slightly negative at some point because inflation is running hot as the economic output. Though basically we don't produce excess value, we just produce excess prices, which are denominated by, which are debased by the denominator itself. Though asset prices go up, that's the way it is. You have to understand it. So what we can see in here is that the value doesn't increase. It's pretty much a range, but the prices keep go up. Though if you bet to the downside on the stock market, you are betting on the fact that we're headed out of stagflation into depression, where there is actual devaluation of assets along with the supply that is shrinking, the supply of money. Though there is an increase on the denominator's rarity. That's the way it is. So, of course, when I look at the market prices, like I said, in a monthly reference chart, makes no sense to be bearish. Everything points to upside potential in the prices, and there's no way this has shown signs of going down. It's just so signs of, okay, we might have found a top, and there are less likely chances to see more excesses down the road. Because of what we've seen, the Fed is going to start the plateau phase, so we're going to have less ease access of credit, and there will be negative consequences of the slowdown in the next year's economy. So I expect the economy not to perform too much, but don't underestimate inflation, debasement, currencies process. Prices still go up for this. That's what the model says. I could be wrong, but the only way I could be wrong is if we switch to a recession that looks like a depression, which means deflation. We need to have far more outpaced credit destructions, bankruptcies and stuff and the like, that actual upside pressures on the model. The model says as well we're in a commodity boom era, so there should be a lot more government spending to subsidize the economy. Though the Fed might stop, but someone else is going to spend, which is going to fuel the inflation to remain elevated in the next years. That's the thing. Okay, so then if we go to the lower time frames where we can find some context, though the weekly chart is where we could contextualize the year ahead, and in here, yeah, sorry to say it, it's not bearish either. We have a clear sign of an upward trend coming out of a range in here, so I'm sorry to say it, moving averages are trading below the rising context. There's no way these can be called bearish. Though the best case we can say is that we come out of a support breakdown in here, and then a V-shaped reverse, which immediately breaks the resistance. That sounds like something I know. Wave 1 extended. We've talked about that multiple times throughout the year, so nothing too fancy in here. You should know about that. The Wave 1 extended create all of their trend in the immediate early stages. Most of market participants are fucked up, meaning that they're taken by surprise by these bull market, or at least bull price movement. Though they generally tend to be very aggressively bullish, and this pattern generally terminates with a couple of pullbacks and a couple of final excess, which means the bull market doesn't terminate. It still goes 2 times above the all-time highs, but it is not in a bull trend. Basically, what we're going to restart in here is nothing close to the bull trend. All of it has already happened, but there will still be rippling effects of that trend by 2 final excesses, and that is consistent with what we've seen before, meaning that I expect that by April or May, we're going to get a nice, nasty pullback, probably because at that point, even though the higher level of inflation, though the debasement of the currency, there will be more economic slowdown due to the shit the Fed has done in November, which I think will correlate into somewhere earlier in this summer, in the early summer, so let's call it April to May. I think this is the moment in which, if we're trading close to all-time high, that will be signed to profit take quickly. But I think we're headed there. I definitely think of it. The risk area for the week ahead means that even if I think this is a pullback and that we have a mature range on the lower time frame, so everything's suited now to just break out of it and go all-time highs, there is a third range boundary on the daily chart. I'm just going to show it very quickly. So this is where the third range boundary is. So this is a very harsh and violent technical level. So consider this area of the 4,500 as very, very dense technical area in the S&P 500. That says that if we were to reject that area for whatever reason, that could be a bearish catalyst, though bear that one in mind. If by May or April we are trading in that area, I will start to think about potentially short-term covering the portfolio for potential downside risks. I would like us to be in all-time highs by then, but that's not a guarantee. Another factor that we've highlighted as well in the earlier moments is that in a net global sentiment, the VIX is likely going to slow down. What we can tell out of this thing is that we've been through some very high historical standard. All year long, we've been trading into that box, meaning that the average level of volatility was somewhere around 25 to 28, which has very limited historical similarities. So the last times we've seen such a things were post-2000s, and that's basically the thing. So yes, we've already had a crash, folks. I mean, just look at the volatility metrics. We definitely have something that happened with the COVID. Though we're in the aftermath of it, and what we've seen on the modeling system is that due to the correlation pattern that I have, no more than a pattern, it says that normally volatility should still be headed down. Not in a single straight line, but something like this kind of channel, that we should be in a downward trend over the next couple of years, in which if we go too complacent in terms of volatility, I personally will trigger profit takings on my trades on the S&P 500. I'd rather like to outperform the S&P 500 by stock picking on some certain categories, but we're not going to talk about that today. And the thing is that when, of course, the volatility picks up too high, my model says the volatility will reduce over time. So when volatility picks up because people scare the fuck out of I don't know what, I'll buy. Just like I said, people are scared, I buy. People get complacent, I'll sell. There will still be a significant importance of psychology in the next years, but this importance will slow down as volatility cools down ahead of more fundamental pricings of supply and demand mechanics by more professional, mathematically driven types of approach. That's what the model says. So I expect volatility to go down. I expect volatility to still be a thing in 2023, but not as much as it was in 2022. What that tells me in terms of S&P 500 is that the volatility boundaries, the Bollinger Bands, are in here, though I think we might get there. I think we will get back to those volatility boundaries in the not-so-distant future. Like I said, currently they're standing at 4,800, so I think we're headed up here. Don't know how long it's going to take, but when we go out there, of course, like I said, complacency area, this is where I will take some of my profits, both on the speculative trades that I might have on the indices layer, and also take some first profits on my longer-term investment strategy. Okay, so I don't know how long it takes for us to get to the volatility boundaries, but if we go fast earlier this year or there, I will fastly take the profits as well. I don't know anything about the timings 2023 will provide. All I know is that I will pay a lot of attention if we're trading volatility boundaries or even all-time highs or the third range boundary, and more specifically around that timing around, like, say, late March to early May, where I think problems could show up in the credit markets, specifically in the corporate bond junk series. So something to be noticed, and bear that one in mind. So that's for the general stock markets. I think a slowly bullish headed direction on the net S&P 500 return, which is not going to be anything more than the actual inflation itself, meaning that I expect inflation to run hot, and I think by the overall net percentage of the year, bullish or bearish, we shouldn't be pricing in no more than a 50 to 20% gain on the S&P 500, and that will be, of course, outpaced by the levels of inflation. So basically, you don't really make net gains by buying the S&P 500, considering out that the average buying would be the average price of the range, so 4,100. Basically, if by the end of the year we create another range which is just slightly higher, like 15% higher, well, basically that would be doing this, okay? We get out of there, we go all-time high, and we spend all year long then consolidating like that, and we just set to a slightly higher standard, which is no more than, on average, 15% higher than where we were in 2022. Boys, that's not a staggering bull market, but it is still not a market that goes down. Though the dumbest thing to do here is to actually be a net bearish, a short seller, meaning you sell something you don't even own, while still being debased by the currency, meaning you're going to take a loss by short selling the market, as the market will likely go up. And at the same time, the amount of money that you will recover in the end, which is less than what you invested in, is going to have to be debased, because 1 year from now, the money will worth 10% or 15% lower than what it does today. So that's really, really staggeringly stupid to be a short seller in the market today. I think it's very dangerous, even though I do understand the narratives of those who do it by defending that stagflation was just a temporary factor and we'll head straight into depressionary recession type, which I could understand, but unless I do see it, I do not anticipate it to be, because for now we're in stagflation. If it has to be changed, I will readjust, but for now I don't see any reason to. That's the reason for it. Going bearish would be a sign to me to trade below the moving average. So if we were to change course and going out there and successfully close below the moving average, that would be a sign that I'm wrong and that the market is switching to a different narrative, mostly headed into a depressionary recession type. For now, it's mostly pricing in that inflation will remain elevated, and a lot of professionals I've been talking to agree on this, and that in that perspective, the basement still pushes prices higher without nearly thinking about a bull market, because the real economy will suffer from the consequences of 2022 rate hike cycle in which the Fed has made a mistake in November. That's for the general stock market environment. Now, of course, we could have a look at other market classes, like, for example, the European stock markets. Boy, I'm sorry to say it, this as well. I mean, if you call that a bear market, good luck with that. I don't think there are that much gains to make, but same thing goes in here. We've been breaking some massive support in the French index, which is PX1GR for global return. Remember that. Otherwise, this is not dividend reinvested. Do compare what's comparable. Though in France, well, what we have in here is quite a similar story. We've gone from breaking support to breaking resistances instantly. We've got something that looks like a pullback, 38% Fibonacci. Actually, the S&P 500 has gone 50%, which means, well, Europe has gone less violently higher, but it's done a significant level of correction. So yes, I think the European markets will go all-time highs in 2023. Not as well for a bull market, but just because of the debasement of the currency, prices will go up. The actual value of these assets will still be diluted by the denominators losing grounds. Same thing goes for the German DAX, which in here has been consolidated more because the Germany is in a much more trickier situation than France due to its supply of energy. Though I still believe that the German DAX is in a tricky situation, it's still not bullish because in here the moving average is trading inside the context, and the context in here has reversed. If we have a look at the longer term DAX, it's still freakingly bullish. The same old story in here. I don't expect the DAX to collapse. I just think the DAX has much more limited upside potential. I'm not sure the DAX will succeed making all-time highs in the years ahead, because in here it also has the same structure as others, meaning it's gone from massive low point and breaking the resistance afterwards. But the thing is that the German DAX has a total different structure. I doubt the DAX has the strength to go all-time high. It may try, but it's going to require solving the situation in Ukraine. Though it's a big if in here, even though I think there will be improvement on that front on 2023, I can't guarantee that. And until that happens, I remain out of trading the German DAX. I'm mostly trading French stocks for now, and of course US stocks, but I do kind of stay away from German stocks by the exceptions of RWE, which is a utility, but that's a topic for another day. So that's for the stock market, basically. Lots of disparities around the world, but I think net inflation is touching everyone, and that is the leading force to push prices on the market higher. Prices up, that doesn't mean the economy will perform well. That's the thing that you really need to understand. All right, now crypto-specific factors. We've highlighted a lot of them. First one was that there is a significant pressure that is mostly happening around Bitcoin-centric problem due to the fact that for now GBTC still trade a significant discount, and therefore Gemini and all of these DCG related entities have a lot of problems ahead. So for now, there are still risks of pending potential liquidation that will have rippling effects in Bitcoin. That means, well, as Bitcoin is the big daddy in the room, everyone still think that the bear market isn't finished. I would say I'm not 100% agreed with that. I definitely will not anticipate the GBTC situation to be solved until it is. But until then, I don't think DCG and all of this will have necessarily negative consequences. Remember that this is a significant chunk of Bitcoin that is held by GBTC, and if there is even a hole, that doesn't mean necessarily the market will go down. I think this is an inherent problem of Bitcoin that's probably causing Bitcoin to deviate from my personal strategy, which was I doubted that the crypto market will do new lows after this June's bottom. It wasn't the case for Bitcoin. So I've been proven for this one. It is still an underweight of Bitcoin in my personal portfolio. I eventually will consider changing my thoughts on this, but not for now. At least not until we've seen a positive resolution of that GBTC discount. I don't know how it's going to play out. All I know is that this is infinitely complicated, much more complicated than what people tend to say in social medias. So don't be dumb enough. We're talking about big and tremendous amount of big money. So certainly not easy thought process in here to explain what truly is happening. And I'm not going to go down trying to give an explanation. All I would say is that my personal assumption on Bitcoin is always the same. The thesis is always the same. Don't ever mix up the different cycle. Bitcoin is the oldest cryptocurrency out there. It is in an adoption cycle that has been 10 years in and probably still 10 years out before we've determined the entire pricing of that asset in its final use case. We're still discovering all of the use cases of Bitcoin, and we are in the adoption curve, which means right now we know what Bitcoin does great. We know what Bitcoin does that any other do better than him, and that's basically storing the value. So Bitcoin is this, and it will have many technical improvements within the next years, I guess, but this is a far, far smaller or slower beast as the longer term of its structure, that's what we've seen on the modeling, understand that Bitcoin will take much longer than you think to actually get to its final stages, probably a decade old from now. It's a decade old, and it's still probably another decade to come until Bitcoin finishes its evolution cycle. It also means that it is more advanced than the other, as we already have signs of progression through the chasm. Remember that the chasm is characterized by a huge turnout in the supply, which means a lot of the supply is changing hands until, of course, we go out of the chasm by the smart money taking that supply in hands, putting it into a scarcity level in which, of course, preceding the adoption and the technological breakthrough, the smart money anticipates, and they definitely take on that supply, wait for the adoption to come in, the organic natural adoption cycle, the organic demand on the market, and as this demand goes in, that supply that has been held by the smart money is slowly released in the market. Like really bite by bite, they will feed you, but that means anyway, the demand will outpace the supply, which means one fucking thing, prices go up. That's really the way it is. Not even mentioning the currency debasement of the fucking dollars or euros or wherever a currency you are trading on. So that's really, really important to understand that. I don't see any thesis over the long term that is bearish for crypto on the good ones. Like I've always said, there are plenty of shit in crypto, but there are a few ones that don't have to prove anything anymore. They're really passed through the chasm, which means adoption is coming. It's just a matter of time. On Bitcoin, the risk is the time, actually, because the time scale we're talking about in here is so large. We're talking about an adoption that could take between now and 2 to 3 years, because we know the adoption globally is going to happen within 10 years. So normally we're pretty much closer to the breakthrough than we think, but we can hardly put a timestamp on it. So Bitcoin's actual problem is its length of the cycle. So I don't think Bitcoin is leading the market anymore. I think Bitcoin has its next halving, and my thesis has always been this: the next cycle of adoption comes from the pragmatists. These guys won't use 20x leverage and bullshit like that. They would just be buying the thing because it works and because they have use cases for it. And moreover, the technological breakthrough will bring new use cases to these technologies as they get adopted in the same time. So that's the double gang, which tells me anyway Bitcoin thesis is bullish within the next years, but that's the problem. It can take multiple years, and it doesn't necessarily guarantee to fit in between the timescales of today's analysis. So I would say Bitcoin, yes, but I'm not sure there's going to be a tremendous proportions of statistical odds that tells me a story for 2023. So I would say I have a longer term vision for Bitcoin. Every dollar or euro or whatever I've put it into Bitcoin, this is not the asset that I bought the most, but I always bought a bit of it on each and every dip. The thing is that this are limited reinforcement. Most of my investment in crypto has been in Bitcoin has been made in 2019, and basically I have a base cost per unit which is pretty damn low. I'm a net gainer in Bitcoin, and like I said, I don't play the party of just a few months or a year ahead of now. I am playing the longer run, and I don't know if Bitcoin will fit into the next year or couple of years timescale. I just know anyway, it's going to take longer, but it's going to be there, and it's already past the chasm period to me, so adoption is only going to come. It's just a matter of when people realize it and when the technological breakthroughs start to occur. All right, next in line, Ethereum. Remember what we stated, we need to treat all those assets as different buckets. Don't think crypto with a big C. It's not going to happen anymore. We've got far different timescales and time horizons in those markets. Ethereum has experienced its bubble phase, okay, and has now had what seems to be an absolute fake market, which has been built on expected demands and built out of leveraged positions of people anticipating that adoption, stuff like that. We've been sold that narrative that the institutionals were adopting things and whatever. We've just discovered out of 2022 that, well, boys, we might have gone too fast. It was basically just a narrative. We all bought in this super cycle stuff. I had signs that the market was trend following, but actually it turns out it wasn't. The market was blind, and we've been painfully proven wrong with that thesis of the super cycle, because basically it was fueled by credits and people who were actively swimming naked when they were even trading with the fucking clients' funds, which isn't even worse than that. Though on Ethereum, I think we have passed as well that chasm by the fact that all of that dumb money accumulation of Ethereum, like, well, this is the future, bro, buying NFTs and all of that bullshit, DeFi is the future, all the 2021 narratives actually turned out, some of them were wrong, like most of the NFT have crashed absolutely dramatically, and we've seen the aftermath of it. All of these bullshit people that were offered NFT or actually even paid to promote them to the noobs and stupid traders who were buying it just to be part of a club. Basic bullshit, though we've seen the aftermath of it. All the liars have been uncovered. And we've also seen one thing, DeFi just works fucking great. I'm sorry to say it, folks, DeFi might have been oversold a bit, or overbought in 2021, but definitely if there's one thing I take away from 2022, centralized exchange fail, decentralized exchange haven't failed at all. So it's really one thing to take away from this. DeFi is no longer a thing. It's really, really something that works out very well. So that's the thesis. Like I said, some of the things were overblown, absolutely outrageously stupid, speculative, leveraged, collateralized positions of people buying with the asset itself on collateral. I mean, it's absolute staggering bullshit. But the thing is that in the end, lots of things still there. There was lots of scaling issues in 2021 with Ethereum. Now is no longer the case. Layer 2s are taking over. They're taking quickly over. And the thing is that Ethereum is now much more scalable than back then. So there was a lot of problem with DeFi scalability. Now it's no longer the case. DeFi is really, really, really turning to be a thing. And now the scalability issues are off the table. So sorry about all the layer 1s bullshit killer stuff. We'll talk about them right after. But Ethereum, I think we've passed the chasm, but we've passed it through an absolutely violent way, meaning that people got overblown, buying the top, selling the bottom, but we still had that shakeout, meaning that most of the bad actors are out because they've been using too much leverage and they've been collateralizing the debt and then just ended up being flushed away of Ethereum because they've been taking risks on other asset classes. So I think Ethereum has been a collateral damage because of the overblown expectations and the thing that we might have started that bull market a bit too early. Just because, yes, on Ethereum's roadmap and lifespan, it's been following Bitcoin in 2021, but I think it wasn't ready to scale at that point. There were still a bit of things that had to come down the path, things that are here today. So once again, I think it's just a problem of timing. We might have gone too fast, too quickly, too far. But we have pulled back, but the problems that we uncovered in the process are already solved. So I don't think Ethereum is going to go anywhere lower than that. It's consistently typical with a wave 5 extended, which means the first trend has been entirely destroyed. We've retraced right down to the breakout level. We've erased everything that the bubble created. This was basically the same old story. This was the bottom and stuff like that. Actually, I think the chasm has happened right now. It's been a huge chasm. And remember, the chasm is where the visionaries have bought. They get to shuffle the decks and shuffle the supply before actual smart money buys in the supply, the big shuffling decks. And next is the adoption of the pragmatists. And I think Ethereum is all around that. The next phase is going to be the pragmatist using Ethereum because that's just a freakingly fucking good network. I'm sorry to say it, but there's not even a bit of competition that can pretend to go along with Ethereum. They've all epically failed within 2022, where Ethereum just kept shining brighter and brighter. There are still some short-term issues, don't get me wrong with that, but I think there are just more cyclical problems of the rest of the market that makes Ethereum a collateral damage. But I doubt Ethereum is going to go anywhere lower. It is going to be demanded just because it does what others can't do. Provide a truly decentralized network with a lot of resilience, providing security that no one can match for now, and offering scalability solutions for those who want cheaper access to gas fees. Though there are definitely a lot of the problems back then that have been solved, I'm sorry to say it, value of Ethereum goes up. We are definitely below valuation on Ethereum. It might take a longer term until we figure out the crypto-centric problems, the issue like the GBTCs and stuff, but once it's settled, I see absolutely no bear case for Ethereum, and the price structure says it as well. We can clearly see that there's been a trend attempt back then. It's been uncovered as being totally fake. going back to the breakout level. The second attempt goes to a 1-to-1 ratio, and when it tries to trend, it fails, and it goes right back to the previous all-time high, which is basically no more than the wave 5 extended structure, which says one thing: the value is clearly going up, and if there's a trend, it's going to be wave 5 extended, meaning that the next and final wave of that sequence will pull out the trend. What that says is that I already know that this trend will be excessive, meaning that don't call this one a bubble, because the next cycle is going to be very bullish on Ethereum. It's going to be a totally different market scheme in here. The wave 5 extended are absolutely violent in their final wave, but they are not going to reverse, meaning that this is not going to be the same old bubble in which we're going to lose 60% or 70% afterwards. I think Ethereum's will never ever be traded below 4,000 afterwards in the future. Remember that trends move value area A to a value area B. It might be a bit volatile due to same old speculators who are going to try to get rich quick, but until then, Ethereum will have real-world use cases and technological breakthrough to support the prices over time. So if it tries to dip, to be honest, I think it's not going to be a 60, 70, 80% drawdown anymore. 60 might still be doable, but I hardly think more than that. So next wave is going to be excessive for Ethereum. I think it's going to happen by the lifespan hour analysis. I think it's hardly going to be more than 2025. Could be, but we'll see. Though, let's just get ready for it. I don't know how long it's going to take to solve crypto problems, but when the bull market goes up, I think Ethereum is going to be the leader of this, or at least one of Bitcoin's overperforming assets. And if it does, if it ever succeeds going back all-time highs, it's going to be excessive, folks, and it's going to be normal. It's not going to be excessive because there's a shitload of speculators like 2019. It's just going to be because there will be organic demand for the supply, but no supply to be found. Because that's what the Chasm do. It shuffles the deck from weak hands into stronger hands, which means those stronger hands will not release their coins until they deemed to think the price is good. And definitely, we don't think the price is good now. So those who held and still hold that supply now, we're not going to release the coins at $2,500. I mean, you're never going to get an ETH from me at that price. I'm ready to give my ETH at 8,000 and above. Until then, well, I'll wait. Sooner or later, you're going to need that ETH because this network is moving on. Its adoption phase is crazily there. I have no longer doubts about Ethereum's, and no one does. So there's one thing. There's one variable in here that is time as well. But if you understood me well, the time constraint in Ethereum is much shorter timed than it is for Bitcoin. Ethereum's adoption has already started, and it's doing quick. We're not in a 10-year history of Bitcoin. Ethereum goes faster. It certainly goes as fast as centralized exchange can because it's a decentralized structure, so it's slow, it's messy, and all of this, but it still moves forward, and it moves faster than Bitcoin. So I think, like I've said, next cycle is more Ethereum-centered than any cycle before. I think this time around, Bitcoin may actually follow Ethereum because Bitcoin as well doesn't necessarily need to wait for the halving. Halvings one by one gets less and less diluted, get less and less impactful on the supply side, but on the other hand, adoption will take over, meaning that we're going to switch from a supply side price action in Bitcoin to a demand side because of the improvements and the use cases in the real world of Bitcoins. That's the thing. For Bitcoins and Ethereum, I think they do no longer have to prove anything to anyone. They will be there, and people are going to need it. And those who have the supply now will not let go with a 40% gain. That's the thing you have to understand. There will be not enough supply for the demand to come. It may take longer, though I don't know if 2023 is going to be it. All I can tell is that there are very limited chances for us to trade below that moving average on Ethereum. That's it. For Bitcoin, might be a different case scenario because there are inherent costs of Bitcoin due to the mining problem, which is a current other problem. So once we solve the mining issue, of course, Bitcoin will recover very quickly as well. Other assets. So we've mentioned Link in our fundamental analysis, and I'd like to do a quick review on that one. The asset chart in here is a much more complicated kind of forecast. This is a much rarer type of pattern, which is multi-time frame breakout, which means we come out of a range and we break out multi-time frame ranges all at once. Generally, that pattern has a very complicated scheme to orchestrate to keep on following, and this has been the case for Chainlink. So I'm not going to go down the nitty-gritty details of all of it, but this is where the first time frame pullback occurred, the daily pullback, the first final access in here, the second pullback has occurred in here or in here. This was the weekly pullback, followed by another excessive market afterwards, which is absolutely required for that pattern to play out, which means in here we're trading the higher time frame, the third higher time frame pullback, which is exactly what we see with that bearish cycle terminated. And what I know with this pattern is that the final pullback is generally very deep, so it explains how bearish Link has been. It generally retraces to the rising moving average, same old story, and it generally doesn't go anywhere beyond the second pullbacks, meaning that the pullbacks are generally ascending. On very rare and violent cases, it retraces right down to the previous pullback, but it can hardly trade below. And that's exactly what we can see so far. Despite all the tremendous attacks, Link is moving forward. It's doing things that others can't. It's the most decentralized and secure oracle out there, and there are plenty of technological breakthroughs ahead as well in here. It's just that multi-time frame breakout tend to overextend the first stages of the rally, and the final pullback is generally very violent and deep, but that doesn't mean the value isn't there. So there's one thing I can tell you, Link has definitely already printed that its average value is setting at least $10 billion valuation, at least 11 to 12. Just taking 50% from peak to trough. So basically, this is what it is. That's the price of Link. So currently, it's trading at quite a discount. And moreover, what that pattern says is that we'll go all-time highs again. Probably with the demand, with natural demand for the token. Like I said, not speculative bullshit of people willing to make 20x returns or bullshit like that. Don't expect 20x. In here, that would be a maximum, something like a 6 to 10x. To go back all-time highs and take the profits, because afterwards we're going to go too expensive and the value will go back there and settle. But the value of this thing is here. This is not a bubble structure. This is a trend structure, just with a very unconventional way of doing things. Okay? But there is one difference. Bubbles don't shift value. Bubbles are just moving prices up and then down, and generally that's just people have been sold a stupid narrative. Multi-time frame trends are totally different beasts. They do shift the value, so I can't tell you with a high certainty that this thing worth at least $10 billion on average value. So currently sitting at $3 billion, yes, I'm in. That's for Chainlink. Of course, Altnet Layer 1, Solanas, AVAX, Theta's, and the like, all the same thing, okay? So it's basically pump and dump. Market going up and then down. We're gone to retrace all the way down to where the market broke. That's what happened in here for Theta, who has been breaking to a trend around that point. So I don't know how low it can go. It can still go lower. Same thing has happened for AVAX. The breakout has happened in here. We've retraced to the breakout level. It's been absolutely staggeringly stupidly priced in. So the probabilities of these assets ever returning to all-time highs are close to zero in their time span. Remember that. In here, we're going to have to follow the peak of the trough of delusion and eventually pass through the chasm, which means right now, these things are going through the chasm. The AVAX, the Solanas, and the like. Which means I want to see the decks shuffled. I want to see basically the small hands capitulating to stronger hands, accumulating slowly but steadily. Am I still bullish on AVAX, Thetas, and Solanas? Yes, I just know that there is a very limited chance for all of them to succeed. And most importantly, there's another thing that I need to highlight is that as the global crypto market matures, the big actors who are taking the leading spots in smart contract currencies like Ethereum, in store of values like Bitcoin, just leaves very limited room for others to compete with. So all of these next cycle kind of potential emerging currencies have to do something different in that. So whoever is playing the smart contract cryptocurrency stuff, well, I hardly see them competing with Ethereum rather than niche competing. So could definitely be a niche with Solana in proof of history, though I can definitely see that one try to recover. But damn it, man, look at the valuations. I don't think such a liquidity pocket can ever restore value to $60 billion. I hardly see how this can happen. I definitely think there's a future for Solana and use cases, but I hardly think this one will ever go back all-time highs. Possibly for AVAX, but it's not going to be an easy task, and it's going to take long, and I would like to see the decks shuffled. I've highlighted multiple times throughout the latest cycle that people were buying AVAX for absolutely outrageously stupid reasons, where on the other hand, I warned you and you didn't listen that the supply of AVAX was full of shit and that you were the opponent traders of VC trading, and that when they will start selling, they will definitely crush you down. Exactly what happened. So now I would like to see all the retail hands holding those tokens start to sell them to stronger hands and the like. So I'd like to see these things cooling down, recover, and eventually AVAX could succeed breaking down all-time highs, kind of following the Ethereum's leader thing, but I would like to see them changing hands and changing narratives. AVAX, stupid bullshit ETH killer narrative, I've said it back then, is full of shit. My money has always been on ETH, and I was right doing so. Though, I think the Ethereum one narrative killer stuff has to change. I think AVAX actually has some good tech, but what the tech has, I'll have to look at what it is. The advantage of Solana's and the difference Solana has with Ethereum and alike, the niche at which it can compete, is I think it's a consensus application. The AVAX protocol has something very, very interesting, which is that slash-free participation. You can participate in the network without any risks of being slashed. This consensus of kind of gossip propagation means it can be very effective in one particular way in which cryptocurrencies can be efficient. That would be social networking. I think kind of decentralized social network could very well make use of the Avalanche protocol and Avalanche consensus, but I would like to see AVAX changing the fucking narrative out of just trying to build a better EVM and going into what you do that others can hardly follow on, which I think is that good thing that the AVAX can do that others can't. If that happens, if I see some of the leaderships being changed, if I see the turnover in the tokens, I will be consistently saying that I think AVAX can recover. Until then, lots of challenges, and I still have it in my portfolio, but as a kind of lower end thing that I forget, and that I know if it recovers, will take years to get there. And same thing, of course, goes for Theta. Another project we need to talk about, which has a different structure than the others, is, Monero. Though those who are familiar with me knows what this one is all about. It's basically a hedge in terms of secrecy for me. Though in that thing, I think privacy layer is an absolutely required. Like I've always said, you're going to see the price of privacy when you're going to miss it because you've already lost it. So that's really the thing, okay? When you're going to need privacy, it's going to be too late. Though I goddamn hope this will not be necessary anytime soon, because that will be the sign that there is a significant problem with the privacy in our future lives. CBDC's bullshit and all these things, the WEF vision, view all nothing, whatever shit thing. If that ever turns out to be the future, boy, I'll be happy to have bought my Monero before, because they will make anything they can to make that thing illegal, inaccessible, and stuff like that. So considering it as an insurance rather than anything else, that doesn't mean I'm willing to do illegal activities and buy guns. That just means I want to have access to privacy if I want to, because there's no way you can take it away from me, you assholes. That's really the thing, okay? So privacy as an insurance layer, nothing more than that. Don't buy Monero to just get rich quick and so on. The technical structure in here is the same old that we've highlighted back then. It's a cup and handle structure, which means in here can take longer, but if it ever goes back to all-time highs, it's not going to be pretty. Like I said, I wish it doesn't, because if it does, that means we have a problem with privacy. But that's it. The Monero is a specific guy factor, and it's trading rising moving averages, so definitely consistent with the pattern. I'm sorry to say it, it's not just vision in my head. It's definitely the way it is. Monero shows definitely interesting patterns. What I like as well is that one of the rare coins which is still building higher low points out of this summer's lows. That's also the fact for Ethereum, and also my big boy Atom, which is gonna talk about right now. We're going to terminate with this one. That's another thing that I've been documenting a lot on the YouTube channel, and like lots of educative content around Cosmos in general. Because don't be dumb enough to mix Atom with Cosmos Hub, the Cosmos Hub with the Cosmos ecosystem, where I think tremendous growth is ahead, and for multiple reasons, which we're going to highlight. I think the Cosmos ecosystem is thriving already, even in a bear market. But that doesn't mean the Cosmos Hub will accrue value from this. It's not a certainty. It may happen, but it's not guaranteed. That's also the reason why I've always made it clear this is where adoption will go, due to a model that I always follow, that is the path of least resistance. Devs had multiple choices. They could go everywhere. They were welcomed everywhere. There was money all across the board. AVAX was paying devs a shitload of money. Same thing was happening everywhere. Solana and other, you were paid to build on the ecosystems. You didn't really have to build something new. You could just fork something existing and you would make a lot of buckets, a lot of deep pockets in the process. So there was definitely an environment in which, like I said, lots of devs were incentivized to work in crypto. Most of them were there for the short run. They were there for the money. There was one ecosystem instead in which I said, I see these guys and they don't play the same game. They play the longer game, and most importantly, they don't play the subsidizing short-term bullshit in which, come here, you're going to get a nice bucket of money, and then if you want to run away, you run away. This is one of very rare ecosystems that has been having developer retention far more than any other, and that's the only 22-year-on ecosystem that has been nearly doubling its dev force, where others have been dividing by 2 or even more for some. So most of these other shorter term ecosystems that were incentivizing their devs have been basically showing desert. They've all deserted. They've gone where? In the Cosmos ecosystem. Not for all of them, but for most of them. And that's one critical component to me. The adoption of that tech stack is not just random. It's a sign that this is where it's going because it's consistent with all the models that have been repeating for years now. This is where it had to go because that's where the passive least resistance is. Every dev is starting to figure it out now. If you want to take some money out of your decent work, not just copying some existing fucking code to get a grant, go in Cosmos. No one's going to take that money off of your hands. Create something and you're going to take it all for yourself. You're still going to have to pay for security and stuff like that, but these things are going to be sorted out very, very quickly. Innovative solutions are coming along the way in 2023 in Cosmos, and very, very innovative ones. There are lots of people building in that ecosystem, and this is where the activity goes on. I've always said it, follow the fucking devs. Don't necessarily follow the money. The money can turn everyone's head and mostly do it in the short term. If the wave goes back, we'll see whoever was swimming naked. And to be honest, I think all the AVAXs and Solanas were actually swimming naked. They were playing with credit. They were giving away their tokens so that you could buy and accrue value to the token itself. So this is the closed loop. And now we've seen that this doesn't work out. Instead, the devs are going somewhere where they think they can build durable value. And like I've always said, path of least resistance. I always pleaded for Cosmos ecosystem to take on these, and it's already showing signs of verifications. We'll see if 2023 is the year for Cosmos. It's one of the rare ecosystem that hasn't played the pump and dump scheme. This is an open platform, an open tech stack, which means basically they're full of shit projects in Cosmos, that's for sure. We've seen absolutely tremendous Ponzi schemes in here, Terra just being one of them. There are many other tokens that are just straight line to zero in the Cosmos ecosystem, but there are very, very smart people out there. Many of them are actually working directly or indirectly with the Cosmos Hub. Reason why I personally think the Cosmos Hub is a safer long-term bet, but that doesn't mean it's not going to fall down the cracks of speculation. I definitely think there's going to be a lot of stupid things happening in the Cosmos during the next cycle, because Cosmos does one thing that other ecosystems don't. As usual, I've made a video about that months ago because I'm always light years ahead of the market, sometime way too ahead of the market. But I've made that video about governance, and I said Cosmos is all about governance, bringing governance tools and improving on the governance stack. Though if there's one thing that I think we can still improve on in terms of market maturity and cycles, like we stated, don't ever think any currency is going to compete with Bitcoin in storing value in a cryptocurrency form. Don't ever think anyone is ever going to compete with Ethereum in a decentralized computer, smart contract currency, and stuff like that. Forget about it. Ethereum's won the battle and others lost. So Others can just, at best, pretend to be leaders in a niche, but definitely the money stands in Ethereum. I've always made it clear, and I was right about that. Next is, if you try to think about another angle, something that doesn't do store of value, something that doesn't do DeFi, and anything that is extracting value vertically, which means in order to use Ethereum, you're going to have to be able to afford it. So it has to be some monetary throughput to make use of Ethereum. Though DeFi is likely going to stay there, decentralized identity likely as well. Though what could be left? All that Web3 stuff, and I think blockchain technology, if there's one thing they can do and improve on that they haven't tried already, like changing the money, changing the financial system, Bitcoin, Ethereum, yeah, what next? What can we change? I think we can change the way governance work, the way enterprise architectures work, the fucking DAOs. And I think Cosmos has forever been headed for this. They were light years away from the others in that direction, saying, well, I think there's going to be hundreds, not thousands of blockchains, because block space is going to become a commodity, not for DeFi, not for just financial applications, but for anything data related, social coordination, and anything aside from just trying to extract a shitload of value. But just removing trust human assumptions by smart contract that don't necessarily deal with just value and token swaps and token transfers, but instead that share about different architectural stuff. Like I said, human coordinations, DAO stuff, non-financial organizations, non-governmental organizations, all of these things I think are going to thrive in the Cosmos. And I think if there's one angle that we need to try with cryptocurrency techniques to try revolutionizing existing system, that's in that system. Though this is why I think the next cycle, if there's one that can have chances of bringing attention, I think this is it. DAO, governance tech stacks, and stuff like that. Though don't get me wrong, I definitely think it's going to be absolutely stupid. Because just like every bubble, remember the maturity cycle. What could that be for Cosmos? The hype phase. So I think there could be a hype phase in the Cosmos ecosystem all around that DAO, Web3, social coordination bullshit, which is likely going to create massive DAO Ponzi and things like that. Though I expect this thing to be pump and dump. I think that despite the smart people being in Cosmos, they won't be able to stop the wave from coming. So I think Atom, just like the rest of the Cosmos ecosystem in general, will likely turn stupid, meaning way more speculative demand than available supply, and I think that may create absolutely stupid excessive market prices in Atom. Atom is a token that hasn't had its pump and dump already. I mean, clearly it wasn't the case. I mean, just look at the returns compared to the other, it's really a non-event. Though this is really something staggering to me. I think Cosmos either never will be a thing, but if it does turn out to be a thing, it's going to go quickly up. Remember my last year's target was $100, and I said going above 100 is where I think Atom is correctly priced in, but if we go it in a straight line, I will profit take and buy again later. I will still have that same thing. But now I have much more than that, because this is exactly one pattern that I know as well, which is Wave 5 extended. It's just the same thing as Ethereum, but without a bubble to precede it. We've tried a trend coming out of a range. We've erased that trend immediately, going right back to the breakout level. If we succeed going down, going up to the all-time highs again, this will likely be creating exactly as Ethereum did back then. It's probably going to sell the future. Well, DAO is the way we're going to coordinate stuff. And turns out, bam, no way, no shit, Sherlock. We go back to all-time highs, to previous all-time high. We create this overlap, and we go in a Wave 5 extended. I definitely think that's very speculative, because of course it requires many dominoes to fall in the same, in a specific order. But I think that if for whatever reason people go nuts about Cosmos, they will be dumb enough to buy Atom, because Atom is the flagship, Cosmos hub, Cosmos ecosystem. I don't know that shit, but I want the token. I know people can be very dumb in their assumptions, and I think there can be very dumb assumptions with Cosmos. And if that's the case, and if Atom gets over the speculative grip of dumb money, then in that perspective, yes, I think $100 is an approximate target in which we can go, just like Ethereum, meaning basically we sell a future that is probably going to be true. Remember that Ethereum's DeFi in 2021 was definitely overbought. But the thing is that it was true just a few years later, and I think Atom will deliver on bringing the first sustainable DAO with tremendous money to support that DAO, but I don't think it's suited for 2023 or 2024. So if Cosmos ever pumps in between the next 2 years, I think it has to be cautiously approached by those who speculate on Cosmos. I personally will profit take in here and buy again later. Not with everything, but probably more than half of my Cosmos exposition or Atom exposition is going to be sold. Though that's really one crucial thing. I'm not saying this will happen. All I'm saying is that anyway, what I bought in Cosmos is part of it I'm willing to go to zero, even if it fails, just because I goddamn like Atom. I like the smart people behind that thing. I like the way it's built. It's very chaotic, decentralized, and it's got all the ethos, which I think if there is ever a chance to revolutionize structural organizations and DAOs and stuff like that, I think the Cosmos Hub will lead in that direction, just like Ethereum will lead DeFi. Though that's my assumption, that's the speculative part of my portfolio, but at least now you know everything about what I think are the top projects for this cycle ahead. Though I'm going to just close on these thoughts by just showing you, for transparency purposes, my portfolio. Just like I said, it isn't for copy trading, just don't be dumb enough to do it. It's just because I think for transparency purposes, been talking to you for an hour long, at least I think I deserve transparency to show you where my money has been put with actual percentage base and stuff like that. So let's go down this road. All right, so this is what it is. Though, like I said, it's consistent with what's been said for a 1 hour long video in here, at least for the crypto portfolio. I have a major portion of my portfolio in Ethereum, which is accounting for 35%, basically consistent with what I've said previously. I want a 60-40 portfolio allocation. Ethereum just being my low risk or risk-free base yield reward by having a validator on Ethereum plus some liquid Ethereum on top of it, which I'm going to be using in DeFi or other stuff when the bull market starts to restart itself. Until then, well, most of them were in lending protocols like Nexo. They've been putting out of it, of course, due to the market context we're in. Safety first. So for now, Ethereum is expressed in those two speculative parts. Validation, low risk reward, or risk-free reward. And on the second part, some liquid Ethereum, which will be destined to do some DeFi when the time comes. Atom is the next one in line, 20% or 20+%. It's varying quickly. Basically, that's in line with what I've said. I think the demand for the next cycle is going to be there. I think, of course, I'm going to have to arbitrage that demand if it goes too speculative too quickly. I don't think this is an ecosystem that can sustain rapid short-term speculative demand. It's very likely going to create the same old bubble pop thing. But some tokens like Atom, I think, have many, many smart people in the background suitable enough to recover from such a market because they are not excessive. And I think even a $100 Atom isn't overpriced. I just think if we do this within the next couple of years, it's probably too quick, and we're probably going to be selling stuff that we won't be able to deliver until another couple of years behind that front. So I'll be willing to take my profits and buy again on the overlap while still holding a portion of my atoms. Just be clear with you guys, a significant, like 50% of my atoms will never be sold. I'm in this thing down to zero, if it has to be the case. Just because that's the way I do things. I've been buying atoms with other tokens, profits, and money, and I'm willing to go down the road with this just because I support the project. I like the people working here, and that's just on a personal scale level. I want to support that project. So portion of my investment is all the way in. Another portion is just like, as a trader, I will have to risk manage. So if I go wrong with the assessment in here, and for example, these DAO stuff just never shows up, or if whatever reason shows that the next cycle demand is elsewhere, then I will switch a portion of that investment into this whatever elsewhere is. Bitcoin, 12%, because I think a portfolio without Bitcoin would be dumb, but a portfolio with too many Bitcoins today would be a too safer goal and play, which I disagree with. We've seen on the model that there is multiple forces that say anyway innovation moves faster in younger coins. So I still believe that phases after phases, the oldest ones now like Bitcoins are very much like dinosaurs. Ethereum moves still quickly, but it's going to slower its pace in the next cycles and the like, even though it has a wave 5 extend. So expect the next movement to be very violent, and it's not going to be a bubble. It's just going to set the standards to where it's supposed to be anyway. But it's going to do it in a pretty unconventional way. So don't be surprised by volatility in Ethereum. It's absolutely normal. It's actually even anticipated by those who look at the prices. Bitcoin, like I said, I have it. I will have more in the future because I expect a few years from now, probably 3 to 4 years, when we'll get into the authoritarian part of the Armstrong cycle, so 2024-5 down to 2028. This is where I'll be more Bitcoin centered, which means I probably profit take a portion of my ETH, the speculative part. I'll still have the ETH validator. I'm never going to take one down. I'll still have a portion of my Atom, but the rest of the market, Link will still have them forever as well as this thing, but probably all of the rest will be taken away. Probably going to keep Monero's forever as well. Like I said, Monero is an insurance layer. Though if it goes through the moon, I will probably sell a portion of it, go back to BTC. That's pretty much it. So BTC is more a safe play that I will play in the era of 2025 to 2028. Until then, I favor more growth-related portfolio orientation to try outpacing the overall market's yielding. So by basically going into more productive coins which will create and thrive innovation. I think next cycle innovation could be about DIO, governance, and all of these things, which I think blockchain technology will try to disrupt. Whether they will succeed or not, I don't know. We'll see all about that. Next in line is Chainlink, for the reasons explained, 6.84%. So if Chainlink goes too much above 10-15% of the portfolio, I'll eventually consider switching to some more safer coins like Bitcoin or Ethereum. But I think Chainlink is on par with Ethereum, and I think both of them will perform very great through the next cycle. It's just if it ends up being faster than the other for whatever reason, I'll eventually reshape the portfolio, but I don't necessarily expect it to be. It's kind of a diversification system from Ethereum. Like I said, I think Ethereum has more potential than Link. I think both of them will retrace to all-time highs, but I think Ethereum will have its uplifting potential due to the Wave 5 extended, where on the opposite hand, Link has made most of its trend already, but it's just going to retrace all-time high, which is still a significant gain out of current prices. And that's something to notify. Next in line is Nexo. Nexo for 5.85%, at least currently. And why the heck do I have this token? Because most of it has been granted to me as a reward for my lending of most of the tokens that I had in Nexo for almost a couple of years. I will explain very, very quickly. So many people have been telling me, well, Phil, Nexo is a Ponzi, it's going to collapse, these guys are scammers, whatever. Lots of FUDs about Nexo, like the proof of reserve is fake, blah, 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 blah. I've had tremendous amount of FUD on Nexo. They're still there. And I had the chance to talk with some people at Nexo, actually, not the headlines and stuff like that, but some people still, and they're very smart people, to be honest. I know how to recognize risk managers when I see some, and there are definitely some of very valuable ones out there. So I think there are people that know the shit they're talking about, just like Mashinsky and all of the bullshit guys like that. I immediately saw they were just dream catchers and, and selling stuff. So to be honest, I don't think Nexo are the liars, even though that also takes a dangerous trust assumption. So I like to make it straightforward in here. It's the same old trust assumption that you have with your banking account, which means you give your money to someone and they give you some rewards in return. That's exactly what Nexo does. So to me, Nexo is a bank. It's regulated, and that's the way it is. There's always going to be a trust assumption. We're in disruptive technology, and they could turn out to leave with your money. I don't think they will. I don't think they've shown signs of willingness to do it. I just think they've showed they were legitimate players willing to go ahead of regulation instead of waiting for them to show up. So to me, to be honest, to me, they're just dedicated builders. They just build stuff, and I got them like that. What I want from centralized entities is to be what they... It is to show the best of what they can do against decentralized technology. Decentralized technology moves slower and chaotically, where on the opposite direction, a centralized force is coordinated, meaning there is a vision behind it. There's some few people who decide where this thing go, though there's a vision, and they move very quickly in the execution. Though that's exactly what I want for Nexo. And to be honest, 2022 has been a staggering amount of new things for Nexo. Despite the bear markets, they've kept delivering new stuff, and I like that. As long as they do it, there's still the risk of them going away with my tokens. I've seriously decreased my exposition on Nexo lending. I've removed all of my Ethereum atoms, Bitcoins, and links on that platform. I still have some other tokens. Basically, the AVAX, Solanas, and all of the and some other smaller coins are still stored in Nexo. That's the way it is. So I still hold those Nexo tokens for two reasons. The first one is the utility of it, because having more Nexo tokens give me the higher loyalty tier out there, which gives me advantages in terms of yield rewards and the cards, credit card rewards. So these are some advantages from the system. If you use Nexo's products, having some Nexos kind of makes sense for the utility of the tokens. And the second portion is something that I've seen very few people actually talking about, but still is very important to me, is that I use the Nexo token as an index. It's kind of a passive investment fund to me, because basically the Nexo token, despite being bringing value by the Nexo team, which means if the Nexo team does good products, the actual value accrual on the token should improve its price. And in the opposite direction, if they do shit job, the token price goes lower. But there is a base value to the token, because it's basically a fee token for rewards on the tokens deposited on the platform. So basically, more tokens deposited and more good tokens deposited means normally the yield should increase on those tokens by the use of Nexo's doing with them. So it's really the way it is. The more tokens are deposited on the Nexo and the more these tokens improve in prices, the more the Nexo token gains value and tractions of inherent supply and demand mechanics. So basically, Nexo acts indirectly as a fund. If the tokens deposited on the platform are going up, Nexo token can do nothing but go up. And that's really the thing that I like. There is some math, though it's very complex math because there are multiple other factors. Like I said, the company's distribution and stuff like that can definitely impact greatly on that front. But they do buy back to compensate. Though it's hard without going into too many details. What I like with Nexo token, on top of the utility, is that passive investment vehicle. With Nexo, I know that as long as they do well with the tokens they hold, normally they should at least follow the market, or eventually at some point even overperform it. And therefore, this is a bucket of liquidity that I don't need to worry about. They will be liquid, I guess. And if I have to pick some tokens of whatever thing to reshape the portfolio, I can take it from Nexo if I think I can do a better job than they do. So this is the way it is. My current cash reserve is Nexo. This is the one that I will use, though it's not a cash reserve, but it's an available token reserve, which is going to be able to swap for other currencies if I think they can perform better than the Nexo kind of bulk representation of market behavior. If I think I have an overperforming opportunity, I can take and sell my Nexos to that token, and over time, when that trade is settled, I will go back to Nexo. I use Nexo as a reference-based layer of reward in the ecosystem. It comes, of course, with the trust assumption risks, and I definitely am aware of it. If you don't know what you're talking about, don't know what you're doing, just don't go there. But if you assess and measure the risks correctly, like I think I do, this is my fucking job, by the way, I think the reward's worth the risk taking. That's the reason why I still hold a significant share of Nexo tokens. Just like I said, this is a bucket of liquidity that I will be willing to take in if I think I can make a better use of it. Until then, I think Nexo is good. I'm not using it for any more than that because I have utility and I use it as an index of crypto. Then comes Osmo and the other ones that we talked about. So like I said, the AVAX, Solana's, Theta's can only be below 2%. So if they try to rise too quickly above 3, 4, 5% of my overall net portfolio, I will stop profit taking to pull them right back down to 2% because this is where they lie. The rest is Cosmos ecosystem related, Osmo, EVMOS and stuff like that. This is how I diversify my portfolio. So net, if you have to understand, 1/3 is in Ethereum, 1/3 is in Cosmos and like. In Cosmos by using Atom and likes. 10% in Bitcoin, that's a safety reserve because I just want to have Bitcoin, and the Bitcoin that I bought are the Bitcoins that I will never sell. A portion of my Bitcoin just can't be swapped for any other thing. It's just going to be Bitcoin forever. I will have more Bitcoin in the future when the time will go into more problems on the regulatory front, specifically when we'll enter the 2025 to 2028 cycle where I think governments will try to crack down violently on currencies. On cryptocurrencies. Chainlink, well, like I said, it's a diversification for Ethereum. I think both have the same time span, so when I take profit on Ethereum, I will take profit on Chainlink accordingly. They both play them with the same timings. Nexo is what I just said, Osmo, and so on. And you get it? Okay? So it's easy to understand. 1/3 ETH, 1/3 Cosmos, and the rest is Bitcoin, Link, Nexo as a reserve, and Monero. And the rest is just minor stuff I just don't want to go out of Theta, Sol, and AVAX because I think they're still good projects, but I know they're going to take years to eventually recover if they do. All right, that's it, folks. 1 hour, 17 minutes. Very fucking long, but I've covered it all. So I hope you've taken some valuable information from this. Happy New Year. Wish you good stuff for 2023. I don't know anything about the timing. I see a lot of people being overly bearish. Like 2022 was just the beginning, worse is still to come. I disagree entirely with that. Like I said, I think 2023 to 4 is going to be bullish. I just don't know how long it's going to take until we figure out the bottom. In crypto, just as well for the stock market, it's still indices of beginning of the year. It might still ripple through a couple of more months, but all I say is that once we start going back to resistances, they will be less resistant than the supports. That's the way it is. The path of least resistance is to the upside, both on cryptos and on the stock market. I don't know how long we're going to try jiggling with supports, but it will have an end. And when it ends, there will be less resistances on the upside. That's the way it is. Not because I think, just because all my models point to that direction. Of course, there are no modern models, so don't ever bet all your futures on leverage things. It can happen. It has far more chances to go to the upside, but that doesn't mean that if you take leverage, we're not going to go down before. And if you get wrecked in between, and if it goes up after you've been wrecked, then that's very stupid. So think of it that way. Go in, go smooth. Don't try to chase the bottom. Be smart. Put your money in the right places and be fucking patient. And that works for both the stock market and the crypto market as well. 2023 is going to be complicated, but not everyone is going to make it out of it. If you are not picky on the assets that you take and you think buying them all is going to make it, I don't think so. That being said, see you guys on the other side. Bye-bye.